Hello, fellow investors, and welcome to another episode of Ritter on Real Estate, where we teach you how to passively invest like a pro. Today, my guest is Paul Moore, and Paul is the founder of Wellings Capital. Paul's journey to success is anything but ordinary. After starting his career at Ford Motor Company, Paul co-founded a staffing firm, was a two-time finalist for Michigan Entrepreneur of the Year, and after selling his company to a publicly traded firm, he discovered his passion for real estate. A lot of similar examples there in my own story, Paul. So maybe we'd get into that a little bit. Over the years, Paul's founded multiple investment and development companies. He's appeared on HGTV and successfully completed over 100 commercial and residential real estate investments and exits. So Paul, thank you very much for being here today.
Ken, it's great to be here. What an honor. Thank you.
Yeah, I mean, your wealth of experience, from exiting your business to finding real estate to all that you've done since then, right? In what was essentially a 20 plus year career. I think we're going to get a ton of value out of learning from you today as we talk about, some really, I think, interesting topics and really core to our audience. I think as I think about what you do, Paul, I think you are, for lack of a better word, a very sophisticated passive investor in how you've aligned your business today with your 8 funds, right? You're picking operators, you're choosing people to partner with, and you have to make a lot of tough decisions in doing that, I think.
Yeah, we really do. It's, we tried to be a multifamily syndicator, and I had a humbly titled book called The Perfect Investment. And I went on the Bigger Pockets. I had a show there for years on Instagram and Facebook Live, and I started saying, time out. It's not the perfect investment. I was wrong. If you have to overpay by 30%, use risky floating rate debt, assuming interest rates won't go up, assuming rents will continue to climb in the double digits every year, if you have to make all those things work to make your deal work, it's not the perfect investment. It's a perfect speculation is what it is. And that's what multifamily turned into for a lot of syndicators and operators between, let's say, 2015 and 2022. The rising tide lifted every boat. But like Warren Buffett said, someday that tide will go out and we'll see who's skinny dipping. And that's exactly what happened starting in March of 2022 with the first of 11 interest rate hikes, right?
I mean, absolutely, right? It was, it's been an interesting couple of years. And, as we've come through that, I think a lot of the groups still standing have proven that, they can't operate. There's no cap rate compression to save you anymore. And I'm sure that there's been a lot of lessons learned kind of coming through that time period. And so I think, as we think about our conversation today, I would love to just delve into, as you look at how you've kind of remodeled, your business, you've created these funds, you're deploying capital. And really, as you're doing that, you're really focusing on who are these sponsors, these operators that you're working with, right? And I'm sure that experience coming through that time into 22 has really educated your decision-making process today. And I think there could be some great golden nuggets for our investors as they go out and try to make investing decisions to hear from you, who does this full time every day, right? That's your main job. And so I would love for you to unpack that a little bit for us and talk about, how do you go about choosing the investments that you choose, and how is your experience of being an operator yourself, even how does that inform how you look at these deals?
Yeah, well, that's a really big question, Kent. Kind of stepping back to the beginning, at a high level, when we pivoted from being a multifamily syndicator to being a fund manager in 2018 and 19, we had this premise in mind, that we as investors, we were looking for 2 things, and that's deep due diligence. In other words, finding the best operators we could possibly find. And number 2, diversification. And we couldn't get both as one single entity. Warren Buffett only has 26 or 27 employees in his office, and he has, they're a Fortune 7 company. And they have, last I checked, about 110 companies that they own or own a part of. They've got all that diversification, but every one of those 100 plus companies has a laser focused management doing one thing really well. And so when we thought about expanding from multifamily, which we weren't doing that well at, to self-storage, we so we'll be mediocre at two things? Are you kidding? And we stepped back and looked at Perry Marshall. Perry Marshall is if you're in the internet world, you might know that name. He's a famous internet marketing guy, but he also wrote a book called 80-20 Sales and Marketing. He used the Pareto principle. And I just drew this out a little bit ago to illustrate this. So the Pareto principle, the 80-20 curve, if you're watching this, it goes up and it slants up and to the right. And so, but basically what it says, first of all, is that if you're an average investor investing in an average deal with an average operator, you're going to get average returns. And that was really, really good while the rising tide was compressing cap rates last decade. But when that tide goes out, you're going to want a much better than average deal, or you might get in trouble. And so the 80-20 rule says that if you're way out here, if you get in the top 20% of operators, or even in the top 10% of operators, you're going to be far, far above the average, as in much safer, much more profitable, much higher debt service coverage ratio as a measurement of safety. And we wanted that. And so we went on a quest to try to find the best of the best operators and get diversification across asset types. And we invest in 6 different asset types, mainly self-storage, mobile home parks, RV parks, light industrial, commercial, retail, and a few more like student housing, RV parks, etc. But we also want diversification across geography. We don't want to just be tied to Florida, We want a diversification across these best-in-class operators, each who are focused, laser focused on this one thing that they're obsessed with and they do well. And even diversification across the capital stack, Kent, which would mean, some debt, some preferred equity, some LP equity. Maybe we'll have mezz debt someday. We don't have it now. And so when we started, our goal was, again, to try to learn to find those best-in-class operators. We made some mistakes along the way. We invested in some deals that I never would again, or with some operators that, turned out to be not as good, but we learned a lot of painful lessons along the way. So I'll take a breath and see if you have any questions before I jump into some more details.
I think that's a great way to set this up. And, as you went on this journey to find these fantastic operators, right? You, like anything, you kiss a few frogs, right? To find your prince. And so, I think some of those stories can be really helpful on, what were those things that didn't go well? The deals you mentioned where you said, man, I wouldn't do that again, right? Or that operator that, man, didn't turn out who I thought they were going to be. Yeah. Were there things as you looked back that said, had I looked at it this way, right? From the start, maybe I would have understood that earlier. Man, I wish I would have asked this question earlier on. Are there some of those key takeaways? Yeah.
We looked at 745 operators and deals last year. Now, some of them we discarded within seconds, but some of them we spent weeks or months on, and we only invested in 5. Here's the crazy thing, Kent, and if everybody who's listening looks back, especially in your earliest years of investing, you'll realize that almost all those deals, in fact, maybe all of them, looked really good up front. Nice website, nice quote unquote glossy brochure. And early in my investment career, I had FOMO so bad, fear of missing out, that I probably would have invested in 5 of the first 10 deals I looked at out of that 745. And they might have worked out all right, but chances are maybe not as well as they could have. So by looking at 745 and saying, no to 99.3% and investing in only 5, we increased our odds of getting better. Did we pick the very best 5? Statistically, probably not. But we're trying to get the safest deals we can because our focus, first of all, is on not losing money. Warren Buffett and Charlie Munger, if you cut their Berkshire Hathaway price by 99% down to 1% of its current price, it would still wallop the S&P 500 over 60 years. And so their obsession is not losing money. We thought that was a pretty good route. So that's our first goal. We're looking at operators who've got years or decades of experience not losing investor money. We're looking for the debt structure. We're looking for people who are not using risky floating rate debt and who are not depending on the economy or depending on interest rates or depending on some exterior factors to make the deal work. We're looking for folks who have an expertise at finding intrinsic value. Warren Buffett, again, quoting him, he said, we're looking for durable asset types. And to us, that would be stuff like mobile home parks that seem to always go up in every economy, run by great management teams with significant intrinsic value. Intrinsic value in our world would be finding, for example, a self-storage facility in an out-of-the-way place, maybe in Kokomo, not downtown Indianapolis. And maybe, that self-storage facility, the operator says, yeah, I've been running this for 40 years since my mom built it, and I'm ready to retire. I got 6 acres out back we're not using, and we're at 100% occupancy. We take a check from everybody every month. And there's so many red flags there. Red flags in my mind being, indicators of potential intrinsic value. The intrinsic value in that deal could be, for example, maybe the 6 acres out back could be used for a cell tower. Maybe it could be paved or graveled and used for boat, RV storage, industrial storage, heavy equipment storage, construction material storage. Maybe there could be a billboard put out on the road. Maybe there could be an ATM machine or a propane filling station. Or maybe they could contract with U-Haul and provide U-Hauls and, add thousands of dollars a month to the bottom line and potentially $1 million to the value of the facility by adding that income. Maybe they could expand and add some, cold storage. Maybe they could add some, there's all kinds of things they could do. I saw a mobile home park that had 2 extra acres out in front. Perfect spot to add self-storage right out at the road. And so lots of intrinsic value opportunities. We're looking for that. We're looking for operators that treat their employees well, that have low employee turnover. We look at how they treat the waiter or the waitress or the flight attendant. We look at we observe how they talk about their spouse, how they talk about their employees and their investors. Because I had an experience where somebody treated a waiter really bad and I got a horrible gut feel, but went forward anyway. Well, 5 years later, they were treating me just as bad. And that's important to us. We want people who know how to love and care for other people because we think that's really important.
Absolutely.
We do a death by Google. We look deeply into what it says online about them, what other people say about them. We do deep criminal background checks, reference checks. We talk to investors and employees in some cases that used to work for them. Warren Buffett calls that the scuttlebutt method, trying to learn all we can just from the street. Honestly, one of the big principles we have now, which was the opposite of FOMO, is we have FOMO, which is the fear of messing up. So we say no a lot. Warren Buffett said, the best investors say no a lot. The very best say no almost all the time.
Absolutely. And that goes back to you picked 5 out of 750 last year, right? And that's a lot of no's. For those ones that you said yes to, like what were those things think about those five that really differentiated those operators, stuck out to you.
Yeah. Well, they had to be in the right asset type. It could be, for example, we don't do hotels, not because they're bad, but we just don't know anything about hotels. So it'd have to be in the right asset type. They were mostly in multifamily, even though, we don't particularly think multifamily is better than others. It just, most of the opportunities presented themselves there. Mm-hmm. They were not rescue capital. These were not deals that were in trouble in any way. These were all, I think, all preferred equity or JV equity deals. So preferred equity, meaning we're in the middle of the capital stack with a buffer of GP equity and LP equity in first loss position, meaning that they would take the first hit if there was a problem. And they also had unlimited upside on those preferred equity deals, at least. And we didn't. We were limited. We would typically get a mid-teens total coupon, maybe a 9% current pay plus a 6% compounding accruing upside, which is, a nice return for being in a safer place in the capital stack. We were looking for operators who didn't, like I said before, didn't use risky floating rate debt. They had a cohesive management team, typically in one location. They had years or decades of experience. They didn't assume a compressed cap rate at exit. They were willing to go and undergo an NOI audit at their expense. That would be a third-party auditor coming in and auditing the net operating income to prove that the income, the revenue and expenses were what they said they were, or hopefully better. All kinds of things like that were part of the mix for us. And like I said, if there were significant concerns, we just walked away.
I hear you. Paul, for some of the folks out there that are, they're passive investors, they're looking for an investment opportunity. They're judging, they're looking at different deals they see online. They're trying to judge, is this the right deal? Is this the right sponsor? Obviously, you guys have a very sophisticated process. What are some of those key things that the average investor can do to kind of cut through a deal and, understand, help them pick the right one?
The thing that scares me, Kent, is when I was a multifamily syndicator, at least kind of a wannabe, about, 10 and 12 years ago. One mistake in a massive spreadsheet, as we all know, can throw off the entire spreadsheet. And it's pretty hard to find that error. Sometime you went in 11 o'clock at night one night and you hard coded a formula wrong or something. That's
can't do that.
It just kind of scares me to think that, how much time does a typical passive investor have to go root all that stuff out? So, as a passive investor, I would be looking really heavily at online reviews. Places like Left Field Investors, which is now called Passive Pockets. Places like, the 506 Group, the Private Investor Club, which is part of the real estate crowdfunding review run by Ian Ippolito. Those places. Invest Clearly. That's a newer one that's really getting a lot of rave reviews. I would just be looking really carefully online because it's very, very hard for a typical passive investor. We have a team of 4 people. And like I said, almost all the deals look good the day they came in. It's very, very hard to root out these issues. And can't tell me if I'm wrong. Push back. Maybe I'm making too much of it, but I'll tell you this, the more we do this, the harder it is because we keep finding new things that could go wrong.
Well, there's a certain ignorance is bliss, right? And a lot of us probably, I wouldn't have done the first deals I did had I known what I know now, right? But you have to get started somewhere. And thankfully those deals actually turned out to be some of my best, but they could have been some of my riskiest.
I get it.
As well, right? But, I think that I think there's a lot of truth in what you said. I like the way that you approach, looking at and really starting with the sponsor, picking the sponsor. I think that's extremely important. I have my own stories before I was an active investor of being a passive investor and losing money in a couple of deals because I chose the wrong sponsor as well. And it was through crowdfunding and all this, and there really weren't the controls that there should have been in place. But I also wonder on these, because I'm aware of all these rating sites, and they kind of grab your information from your website. They don't really do any vetting, on it because, we're on a couple of these sites and unless you pay for it, then, you're just kind of out there because they've just kind of scraped your site. And so, I wonder about that a little bit is, you've got to kind of pay to play a little bit on these. Is there a conflict of interest there? And, I don't know. I'm definitely not opposed to them, but also I think that you've got to make sure that, it's a model that is truly giving, an accurate representation of everyone that's out there.
Well, the private investor club, you and I can't even get in there. I mean, unless we wanted to forge our identity, which I wouldn't do. Mm-hmm. But no, they don't even let syndicators and fund managers in. They have thousands of people on there reviewing their investment experience with Wellings Capital and hundreds of other syndicators. Mm-hmm. So that's just people's experience. They're not scraping in that case.
That sounds like a good resource.
Yeah, I've never been there to the site. I mean, I've been to their website, but I can't get into the club because they won't let us in.
Mm-hmm. Mm-hmm. Well, I think that kind of, and I know Left Field Investors has done, similar, now they're Passive Pockets, is that right? Has done some similar work in that way of kind of these passive investor clubs. I think that's great for investors. I mean, look, when I was an inspiring investor, I mean, I really didn't have a plan to become active in this business. I had another business. I started investing passively in others. And the way I really learned it was attending conferences, and networking with people. And that was before a lot of these clubs existed. But I know some of these clubs where you can join and you can share stories. I think that's a great way to understand people's experiences. I absolutely do. And I also think it is good of what we're trying to achieve of having some sort of rating system. I just think it's got to be, it's kind of got to be regulated a little bit. Right. So, but yeah, I think the idea is all about listening to others, understanding others' mistakes, right? And learning from others, who's had a good experience, why, right? And, like people will ask us for referrals and referrals are great. We try to give people honest, or references, we try to give people honest, references of our real investors to talk to. But inevitably, if you're asking for references, I mean, why would anybody give you somebody that's had a bad experience? Right. Yeah, I mean, right. And so I think these clubs are a great way for people to get involved. I also think conferences are a great way for people to get involved, to really understand. Right. Because as you said, and I completely agree with, it does all start with the sponsor, and it all is about, that person that you're going to really put your trust in. Right. I mean, absolutely. And to the thing about, you can hard code a spreadsheet. Absolutely you can. That's one reason we moved to, just more of an underwriting software that has an audited function, Nice. So because I mean, absolutely, you build these massive spreadsheets, which we've had in the past, and one thing can easily go wrong. And so trying to just really, contain user error and mistakes, I think having it audited is a great way to do that. Yeah. One thing I wanted to touch on, you mentioned that you guys are investing a lot of preferred equity, JV equity. I wonder if you could explain to folks a little bit about that. What does that mean? What is preferred equity? You said it sits in the middle of the capital stack. You mentioned some returns, but give people kind of an overview of what that is and, pros and cons.
Yeah. When people think about investing in real estate, they think of investing in debt or they think of investing in equity. And of course, most of us are, at least recently, the last 10 years, thinking about equity. But there's another option. There's two more options at least. And one is preferred equity. Another one's mezzanine debt. Mezzanine debt would be just like a second mortgage on your home. It's in second lien position. There's no, you're subject to the first lien holder who has the opportunity to foreclose. However, you can foreclose as well as long as you pay off the first debt. And there's no depreciation pass through, of course, because it's debt, not equity. It's tax different. Preferred equity sits in the same place in the capital stack between the debt and the equity. It doesn't have a lien. There is depreciation pass through, so there's paper losses potentially. That's negotiated typically with the sponsor. An example would be in 100% capital stack. Let's say there's typically, for example, 75% debt and 25% equity. And let's say that that sponsor can only raise 20% of the equity, so there's a 5% gap. But let's say furthermore that the high interest rates and the commercial lender pullback has caused the lender to say, I'm only going to loan you 50%. Well, now there's a 25% hole in the middle of the capital stack. So let's say that was a $10 million deal. So $5 million comes in debt and $2 million is in the form of equity. Hopefully some of that's GP and some maybe LPs. Well, there's a $3 million hole there, and that could be filled by preferred equity. Preferred equity would come in that middle spot, which would mean first of all, there's a $2 million buffer between loss and that preferred equity's principal. So if there was $2 million, let's say that property sold for $8.5 million, well, the equity investors would lose 1.5 out of their 2 or 3/4 of their equity, where it wouldn't touch the principal, the preferred equity. The equity holders on that case, though, would have significant upside if it went well, because now there's only 20% equity rather than what there could have been, which would have been up to 50% equity. So those equity holders are in a riskier, but also much more potentially favorable position if it goes well. The preferred equity folks like debt. There is a current pay coupon or current payment, like let's say 7, 8, 9, 10%. And then there's like equity, there's a fixed accruing compounding upside. And that might be 4, 5, 6, 7, 8%. And that accruing upside is, all paid off at the time that the property is typically refinanced or possibly sold. The preferred equity also often has management control, budget approval, and sometimes even forced sale rights. Fannie and Freddie and with agency debt, they often don't allow just anybody to be in that preferred equity seat because they want to make sure it's somebody they really want to be on the deal with.
Yeah, I think good explanation. So kind of summarize, sits higher on the capital stack than the common equity, meaning cash flow first goes to the preferred equity, right? So you're getting cash flow first. You're more protected in that way. But for that protection, you're giving up some of your upside. Your upside is going to be capped.
Right.
And if you're, but you also potentially may have more rights, more decision-making ability, to being in that position, and depending on,
right.
I think the size of that position, right?
Right.
Relative to the total investment. So it can be a great option to come in and have a little more security in your investment, more
right.
of a coupon type payment, right? And you mentioned there
right.
can be two components, one being a current pay component, which you can get monthly or quarterly, and then an accrued component that you're going to get when the deal sells, right? And so I think it could be a great way to increase for those cash flow focused investors who want more safety, care more about cash flow now versus overall opportunity, or just want to lower
right.
their risk. It can be a great option of kind of middle ground, right? Between
right.
debt and common equity. So Great overview, Paul. Well, Paul, appreciate you coming on and talking with us today. I think a lot of great insights on how you're picking deals, picking sponsors, your evolution in this, a little bit on pref equity, which I think is a great, it's a great option for a lot of people out there. Before I let you go, I want to take you through our keys to success. There's 4 questions I want to ask you.
Right.
The first one is, put your passive investor hat on. So you probably keep the same hat on you have right now. And if you could only ask one question to a sponsor before you invest, you don't know about the deal, you don't know about the sponsor, what one question would you ask?
Oh, that's such a harder question because I know so many questions to ask. And I'm not bragging. It's just that's what we do. I guess I would ask, how many years have you been in business?
What are you looking for?
I don't think that would be the one question, but it would certainly be one of the first questions.
Oh, yeah. What are you looking for in that question?
Yeah, we're looking for a cohesive team that stayed laser focused for a long time on one thing. One time we interviewed somebody who had been doing self-storage for 28 years. Yay. But they were raising money for an RV park. Ooh, we wanted to know, we want them to be laser focused on one thing for a long time.
Absolutely. Next question is, what are you most proud of in your career?
I think the way that when we lost money on a deal, on a multifamily deal back in the teens, the way we handled it, we went back to all the investors. I looked in the same camera that I'm looking at today with tears in my eyes. And I said, I'm so sorry. It was my fault. You could blame the economy. You could blame the underground pipes failing. You could blame all kinds of things. Blame me. And furthermore, I will personally reimburse you if you sign up, if you roll this money into this next deal we're working on. I will personally make sure you get back all the returns you expected on that deal, as well as on this future deal.
Oh, very classy move. What's a book that everybody should read?
I would say Gary Keller and Jay Papasan wrote this simple book that we all know called The One Thing. Mm-hmm. And I don't think you can overestimate the importance of that principle. When Warren Buffett and Bill Gates met, the night they met, they both had to write down, what they thought the one most important word or phrase was in business. And they both wrote down the same thing, which was focus.
Fascinating. I actually didn't know that. I didn't know that. That is a great book. I've read the book and definitely recommend that everybody does it too.
Yeah.
Last but not least, what is your number one key to success?
I think my morning routine. I have a morning routine where I take a good amount of time because I'm really fast paced, high energy, type A all day till I go to bed. And my morning routine, I sit quietly. I dim the lights. I'm even getting cracked up thinking about it. Listen to me. No, I'd spend some time meditating, journaling. I focus on ancient scripture and meditate on that. It sounds funny, but I actually use ChatGPT as part of that to look up ancient words and what they mean. And I just think about that, dwell on that. And I know when I haven't done it for 3 days in a row because I get really grumpy.
Mm-hmm. Yeah, I totally understand what you're saying. I similarly meditate, journal, and know when I don't. Absolutely. You realize the impact it has. It's such a simple thing.
Yeah.
Yeah. Love that. Love that key to success. And Paul, thank you so much for coming on the show today. If people want to learn more about what you're working on, they want to learn more about Wellings Capital and investing or what you guys do, how can they reach out to you?
Yeah, they can go to my website, wellingscapital.com. That's WELLINGS, wellingscapital.com. They can get some free special reports and ebooks on investing, commercial real estate, self-storage, mobile home parks, etc. at wellingscapital.com/resources.
Awesome. We'll make sure all that's listed below in the notes so people can access it. Paul, once again, thanks for coming on the show and have a great rest of the day.
Thanks, Kent. Glad to be here.